All right. Looks like everyone's showing up. There's no waiting room to let you guys in. So thanks for joining us. We'll wait a couple more seconds for everybody to get in here. We'll keep the chat open. We'll keep the Q&A box open throughout to communicate with us. Have any questions? All right, well, let's get started. Happy Friday, everybody. My name is Britton Williams. I am a financial advisor over at Calamita Wealth Management. Most of you know Todd Calamita. He's also here behind the scenes. And this is our quarterly webinar. Today we're going to talk about taxes. Everyone loves taxes this time of the year. So, yeah, we've been doing these for a few years now and really enjoy hearing some feedback from you. So, when you do have a question, please throw it in the Q&A and chat. I'll try to stop a couple times. And then, of course, at the end, if you want to stick around, I'll be here. Todd and I will be here for some questions. Also, in the chat, you'll see Todd's going to put our contact information, how to reach out if there's something that you want to talk to us about one-on-one. By all means, you can set up a time, maybe on a more personal level. Have a question, and we're happy to speak with you. We work with a lot of Wells Fargo employees, former employees. My wife used to work there. Todd's wife works there. So we know what you're going through. We know what you have access to over the years, and just over the course of many years, we've organically grown to work with you guys. Um, and yeah, stick around. There'll be a link that's added in the chat at the end. We have a new, uh, we call it a quiz or retirement readiness questionnaire to kind of see you can find out what are some of the weaknesses you have that need to be addressed. Are you ready for retirement? That'll be provided to you in the chat at the end. And I will be sending out a recording as well to everybody. All right, let's get started. Okay, we're going to start here on most recent deadlines. We just passed the March 15th deadline. That was the final day to use or lose the FSA funds. Um, and then you also have PTO, and there's 5 days that you can carry over, but outside of that, you do lose those after March 15th, unless you're in California. There are different rules there. April 15th, we're all watching that date. Some of you may have already filed your taxes. That's the last day to make contributions to your health savings accounts for 2025 and your IRA contributions. If you don't know that, and the amounts that you can contribute are below. So 2025 contribution maximums for the health savings accounts or HSAs, if you have one, for a family is 8,550. And then if you're 55 or older, you can contribute an additional $1,000. IRAs, $7,000 for 2025, an additional 1,000 for 50 plus. Now the HSA, you get the tax deduction going in. The IRA, there's different rules around how much money you make. Do you get a tax deduction on that? So be aware of that. It may be a non-deductible IRA contribution. Let me know if you have questions on that. But yeah, that kind of sets the stage. We're going to be talking about taxes and ways to save you on taxes, each one of these slides. So let me know if you have any questions. But let's talk about the three tax buckets, as we refer to them as. Many of you on here are filling up at least one of these. And it's oftentimes I run into uh, people who have filled up the pre-tax bucket. So we've got the before tax or pre-tax bucket, the Roth or the taxable. Okay. So the before tax and the Roth, you have access to putting money into those inside of the 401k at Wells Fargo, which is great. And there's even a new option for you to put more into the Roth, and I'll talk about that in a second. So the before taxes, you're saving taxes now. The Roth, tax-free withdrawals in retirement, but you'll be paying the tax now. So what do you do? And at the very least, it's good to have a balance between these three. The taxable bucket is essentially referring to if you open up an individual brokerage account outside of the Wells Fargo, um, maybe at Wells Fargo Advisors or Schwab or Fidelity's, you can open up your own account, joint account, trust accounts. That's your taxable bucket, non-retirement money that you're filling up. But man, does that provide you with a lot of freedom in retirement and ways to save on taxes, and I'll get to that in a second. But yeah, it's important to know that there's a balanced approach, and it really depends on each of your situations on which one to put in at which time. But with the taxable bucket, I do want to spend a couple minutes on this. In early retirement, this is the key to saving on taxes. And we're talking about the tax window strategy with Roth conversions, but it's income that you can build up now to pull from to like delay Social Security to a higher level. Um, and it also keeps you in a lower tax bracket if you're living off of the money from a taxable brokerage account in retirement. So that enables you to do things like Roth conversions or pay for the taxes on Roth conversions in order to max out. Like if you're, it's very often I see people who are in the 10 to 12% bracket, and we want to max out that 12% bracket by doing Roth conversions. In other words, converting the before tax into the Roth. You can see like there's a coordination between these buckets. And then another one to be aware of in regards to the taxable bucket is when you sign up for Medicare, you have to pay Part B premiums, and that's based on your income level. It's referred to as IRMA or IRMAA. And that income tier that you're in calculates that premium, but it's based on a tax return 2 years prior. And we're going to talk about how to appeal that when you do retire, because that's a life-changing event, and your income will have dropped. But yeah, those are some strategies with the taxable bucket. But again, the idea here is to pay taxes when you're in a lower bracket. All right. So let's talk about just the differences between the before tax and the Roth. As you can see, I just mentioned it, but yeah, the strategy is simple. Just pay taxes when you're in a lower bracket, but you don't know the future. So it's often that when you're working right now, most of you are in the highest bracket you've ever been in your life. And so getting a tax deduction now makes sense. So you expect to be in a higher bracket. In retirement, you can choose the Roth now. So, but it's a balanced approach. So as you can see at the bottom, consider splitting it 50-50 between the two. And it's also like which one is neglected. So which one do you need to fill up to keep that balanced approach into retirement? And I will mention that inside of the Wells Fargo 401k, as of I think this year, they just announced it. Todd and I were really excited about this, is you can put up to $10,000 into what's called an after-tax bucket, but then convert it into a Roth. And some of the larger tech companies offer this, and this is a great tool to leverage and to use because putting in $10,000 into the Roth, I mean, that's more than you can put into the Roth IRA. So yeah, strongly suggest looking into that. And if you have some questions on the mechanics and how that works, we were just talking about this, Todd and I were beforehand. The way it works is you put the money into the after-tax contributions inside of the Empower website, and there's a in-plan conversion option that will help you convert that to a Roth. All right, so let's pause there for just a couple minutes. See if you have any questions. I think that taxes, it can get very confusing, and I want to make sure I'm you know, wait to hear from you guys if you have any questions. Inside the chat, you can throw any questions or the Q&A. All right, we've got looks like Todd's put in there. Um, the 2026 HSA maximum contributions and also for the IRA. So if you caught up for um, the 2025 IRA, you can go ahead and start contributing to the 2026 levels. It's a good strategy to kind of do it out of sight, out of mind, set up like a monthly contribution to the IRA if you're already doing it. But sometimes people wait for the cash bonus to come in and fill up that bucket. I don't know if you do have an HSA, you can contribute to that within the pay periods, but you can also do it outside of that. And we talk about that at the year-end webinar. All right, any questions? All right. And let's go back one slide here. So I just mentioned the 2026 IRA contributions. What you see up on the screen is the 401k contributions and the catch-up amounts, which is, I'll just go down the list. 24,500 this year, up about $1,000. And then over the age of 50, 7,500. And then the super special age bracket of 60 to 63, that catch-up amount is actually 11,000 to 50. Okay, so Jacqueline, you wrote a good question. She asked if you contribute $10,000 in after-tax contributions and then perform the in-plan conversion to a Roth, does this trigger a taxable event? And you're paying taxes because you're putting $10,000 after tax, you've already paid taxes on it. So beyond that, no, there's no taxable event. And it's similar to like just being able to put more into the Roth portion. But the idea is you're now able to put more into your retirement savings in total, more than what you have been. So as you can see on the screen, you've got 35,750 if you were at 60 to 63, and then you can put even more away and it can grow tax free. So it's similar to being able to do a contribution into a Roth IRA directly, but you're doing it within the plan. All right. Any other questions? The taxable event regarding like getting money into the Roth would be if you did a conversion from an IRA to a Roth. We'll talk about that in a second. Okay. So we've got backdoor Roth IRA. So higher earners. How do you get the money in there? So outside of what we just talked about, you can put money also into your IRAs, but what if you wanted to put it into directly into the Roth IRA? Now, if you make too much money, in other words, according to the IRS, more than $252,000 married filing jointly, then you can't make a direct contribution. So there's a phase out range there as well. But 252 is the good number of your AGI that you have to keep if you have to make less than that to make a direct contribution to the Roth. So the maximum is $7,500. And the backdoor Roth is a way to get in there, but going around the back. So the way you do that is you at your brokerage firm. So again, I mentioned earlier, Charles Schwab, Fidelity, doesn't matter. You've got an IRA and you've got a Roth IRA. So the traditional IRA, you contribute into, and then wait till the funds settle, and then you within the brokerage firm, you do a conversion, and it's essentially you're journaling the funds over, but the distribution from the IRA to the Roth is coded as a Roth conversion. Now, it's important to note, and this is in red below, watch out for the pro rata rule if you have an existing pre-tax IRA assets. In other words, if you have securities or holdings or a basis, as it's referred to as in the traditional IRA, when you do that conversion, that comes into play. And the IRS is going to say, well, you owe taxes on what you've converted based on what you've already have in there. So the way this works to avoid any additional tax is to have zero in the traditional IRA, and this includes other IRAs. All right, so all your IRAs do come into play. So you can't have two IRAs and one with a basis and one doesn't have a basis. There's no way around that. And so this is another reason to keep the money in the 401k if you wanted to do backdoor Roth IRAs. And oftentimes I run into this with clients who have moved from company to company and they ask me, say, hey, should I roll this into a traditional IRA or IRA rollover for you to manage? I'm like, well, let's look at this. It's maybe in your best interest to keep the money at the 401k so we can do these backdoor Roth IRA, backdoor Roth contributions. Again, these seem tricky. We do a lot of these throughout the year. But once you have it set up at where you have the IRAs and the Roth at your broker, it's pretty simple to do. It's just you want to make sure you do have that, be aware of how that pro rata rule works. Okay. Yeah, we're getting into the detail here. Let me know if you have any questions. All right. So we talked about the taxable account a bit earlier. I created a separate slide because it really does open up opportunities to you. And so I just bulleted some of those important points. It's a bridge to retirement, and this is why it matters to you, especially when you want to retire early. It provides you that liquidity. It funds that you can use before you're 59 and a half. That's the magic age because if you're taking money out of the retirement accounts, most of the time that's going to avoid if you're above that age, the 10% excise tax. There is there is a strategy to take the money out of the 401k after separation of employment over the age of 55. I'm happy to talk about that off the call, but I've done that with clients. Did that one with the Wells Fargo client recently. Um, but what he did have was a lot of taxable investments as well, built up through the restricted shares over the years. And the volatility of that stock um, prohibited us to use it because, again, another reason not to have a high concentration of your assets of your money in one asset when it comes to retirement. The other piece is tax management with the taxable accounts. You generate income before Social Security to manage the tax buckets. There's a conversion fuel that I mentioned. So you're paying taxes on the Roth conversions. I mentioned that already. So if you do a Roth conversion in retirement, we'll talk about that, I think, in the next slide. You got to pay taxes, and it's best to not withhold the taxes from the IRA when you convert it to the Roth. Pay it out of money you've already paid taxes on. That's what this account can provide you with. And then 0% capital gains. I've got clients who are in the 10, 12% bracket. They're not paying any capital gains on if we were to realize some of those. So it opens up opportunities to harvest long-term gains tax-free and max out the 12% bracket that way. So the idea is we were trying to max out those lower brackets if you're in it, because it goes from 12 to 22, and you have that 10% tax savings as that strategy by paying taxes in the lower bracket. That's the game. That's the game. Any questions on this or anything that we've covered up to this point? All right, again, the taxable bucket, like for those on the call, it's I see that it's oftentimes you guys get the build up some of the Wells Fargo shares over the years, and if they vest, if they are RSUs and then they vest, that builds up a taxable bucket. Let me see. Got another question here. Okay, so the I got a question regarding it looks like Todd already answered it. So, um, is the new 10,000 conversion from the 401k to the Roth an extra amount contributed, or is it taken from your routine 401k contributions, which has the 24,000 limit? So it is above and beyond the 24,500. So you're allowed to put more in, and it's converted directly within the 401k. Another question by Michael. Um, he asked if you had if you had an old 401k that if you have old 401ks that were converted to IRAs, does it make sense to move them into a current 401k to avoid pro rata? And it depends on your situation, but it is a valid strategy. There are a few things to consider now that Wells Fargo offers the after-tax 401k option. Are you maxing out the 401k, both the regular contribution catch up? So yeah, I think that the theme it really depends on your situation when it comes to these tax strategies. So I don't want you to take what we go over here today as any sort of tax advice or investment advice. That's very important to run these strategies by your CPA, EA, tax advisor, CFP to get some guidance on the investments and how it impacts also any strategies that impact your tax. All great questions, though. All right, so the tax window, I mentioned it earlier. So this is a really key point. If you do retire early and you've got these buckets spread out and balanced, you've got you started building up that taxable bucket. Maybe you've got enough to live on for a year, maybe longer. And the longer you have to live on what you've built up, and and you can delay Social Security, you can delay a pension, and your other sources of income, you're still within that lower two brackets in retirement, and that's going to open up the ability to do Roth conversions. I'm not saying it's definitely going to happen, but this is the time to do it. And an example is got a client and we and and I think it was 10 years of Roth conversions and at $50,000 a piece, and that's a total of $500,000 over time, and he paid 12% on the dollars that he converted versus 22% where he was going to be in the future, and that saved him, the $50,000 on that. And so the strategy is not to do these Roth conversions while you're working in a higher tax bracket, 22, 32%, whatever it may be. It's to do them when you've dropped. And I'm not saying you have to do 10 years to make it worthwhile, but that's an example where it was very worthwhile. So maybe if you have, half the time, then you get half the savings. But this I think the message I'm saying is it's important to get the most bang for your buck is to do it more than 1 year, 2 year, 3 years. You're doing it sequentially to get the benefit. Now, this is assuming that the tax brackets remain the same and things like that. Depends on when you retire. Um, but the idea is to pay the tax at the lower amount. And the way we approach it is I'm going to do these projections for my clients. They give me their tax return, how much money they're making, their pay stub, and I'll forecast it out and see what if they did 20, 30,000 dollars of Roth conversions to max out that bracket. And so yeah, it's referred to as a tax window. And then the idea is you're lowering the RMD liability. So when you turn 73 or 75, depending on your age, you have to take a certain amount out of your pre-tax accounts. That's your IRAs, your pre-tax 401ks. And it comes to about 3% of the balance. And so you can kind of estimate what that is based on the current values, but then you have to remember it's going to grow between now and then as well. And so it allows you this tax window to take advantage of and lower what you're going to have to take out in the future. And then it's going to grow tax free. So that $500,000 did for the client, it grew over time. And then when he takes it out, it's going to be tax free. So yeah, the sooner you can build up the Roth portion, and I think a lot of people are want to get the money in there. And I talk to a lot of people who are like, yeah, I'm interested in doing Roth conversions and or backdoor Roth contribution and stuff like that. But we need to look at like what's it cost to you? Like that's the big question is, okay, well, it is a taxable event, but if you're in a lower tax bracket, that's the ideal time to do it. And this is also, this is identifying when that's going to be. All right. All right, let's move on into a different type of tax strategy away from the investments. And this is going to talk about it's often that this is overlooked. Like, what do you do with the effective rate? What effective tax rate? Whether you're preparing your own taxes or you're using a CPA, somewhere on that tax return on the summary page, it's going to have what your effective rate is or average tax rate. And a lot of people don't know what like, what's the point of it? But it's showing you like what is the actual rate that we're paying taxes. But it can help you with some of the um, strategies around like adjusting your withholdings. And again, this is all estimates, so definitely want to run this by your tax advisor. Um, and more closely, at least with your with a financial advisor to give you some guidance. But the way it's calculated is very simple. So on your tax return, there's a field for total tax, and and then there's a line item for taxable income. Total tax divided by taxable income equals the effective rate. So if we use $80,000 for total tax and $400,000 for taxable income, it gets you a 20% effective rate. Now, what do we do with that? It's I'm using this example because I have clients at Wells who get the restricted shares as part of their bonus, and or the cash bonus is higher than they expected, and then all of a sudden they owe a lot of taxes the next year, or maybe there's some other things that have been going on over time, and they keep owing taxes, and they don't want to do that, and they don't want to pay estimates, and so you can go in here and adjust a dollar amount of the withholdings inside of the Workday website. And so if you know what your effective rate is, now let's see what is the federal tax over gross pay calculation. And so what I'm doing here is showing you step one, you first calculate the withholding rate. So that's federal tax over gross pay. And then step two, you go to Workday into the pay menu, into the withholding elections to add extra withholdings. And you can put a dollar amount. So if your withholding rate from your pay stub is lower than your effective rate, you may owe more taxes. And if you have a spouse who also works, both of you may be making more money over time, and you have to make sure that both of them are in line. In other words, your withholdings is in line. I went through this with my wife over the past couple of years, and I think we finally got it down to a level where we're not going to owe that much. So it, it everybody has a certain feeling around like owing taxes at tax deadline. I don't want to owe a bunch of taxes, and so I'd rather pay it over time, less of a surprise. And so this is a strategy to take your effective rate and apply it to adjusting your withholdings. Happy to talk with you all off the call if there's a specific situation. All right. Medicare surcharges. All right. IRMA. I talked about this earlier, if you may remember. This is the Part B of your Medicare. So most of you may not be on Medicare yet because you've got the health insurance through Wells Fargo. But if you are, you're paying Part B. It's one of the parts in there, and there's really nothing more confusing than Medicare. So this is something to be aware of because it's the premium, Part B premiums based on your income level, income tier, or your MAGI, or just simply your adjusted gross income on your tax return. So the reason why I'm bringing this up is when you retire, if you're making, you know, in these two brackets, $342,000 to $410,000 in combined household income, then your Part B is $455, just under $455. Okay. The the current year's income tiers are based on the 2024 tax return. So it's what you were making 2 years ago. And then next year is the prior year and so on. So if you retire in 2026, you should have, and your income's dropping to the lower tier, then you need to appeal the Medicare surcharge. Many people don't know this, and you can simply download a form, and it's at the bottom of this slide. It's SSA.44. We help our clients fill this out very often. Just talked with a client this week about it. And so the way it works is the SSA, the Social Security Administration, will refund you the money if you've already paid it and adjust it based on the estimate that you state on the form. And just be aware that if you do make above that, then you could be kicked back up into the tier and owe some money. But if you do drop into a lower tier, you know, when you retire, because you are earning less, then you need to appeal it and make sure you don't get stuck with a 2-year-old adjusted gross income level. And remember, you and your spouse both pay this premium, so it can compound with the savings because it's based on the household income. Okay, but yeah, Medicare. I just want to hone in on this one section because this premium can really add up. There are other tiers on involved. I didn't add the other ones, but these are the two that I'm using as an example. Donor advised funds. These I really like DAFs, as we refer to them as short donor advised funds. If any of you on the call are charitably inclined, you tithe, you contribute to your favorite charities. Maybe you give to several of them during the year. This is a strategy to ensure that or give you a way to almost kind of like super fund and get a big tax deduction for what you're putting what you're going to be donating, not just now but over time. Okay, so the example I give here is if you're giving $10,000 and you're using the standard deduction of $30,000 and you're not itemizing your deductions, then you're not getting any benefit on the tax side. The charities are getting the money. But what if you did $50,000 up front worth, then you're going to get a tax savings. Then you can itemize your deductions, you're above and beyond the standard deduction of $30,000. And you don't need to use cash. You don't need to use after-tax dollars. You can donate, you can use stock. So it's oftentimes that I have clients who've got some, old Wells Fargo stocks at low basis, and they'll put it into the donor advised fund. The DAF converts it or sells it and but keeps it invested to grow tax free. Now, what is a DAF? How does that work? It's an account essentially that's opened up at, again, the same brokerage firms that I mentioned earlier or others, Schwab, Fidelity, and it's open up your own foundation or charitable fund. So it's kind of you put your name on it and money going into this it's basically in the eyes of the IRS, it's a 501c, so it is a charitable donation going into these funds. So the shares that you add to it or the cash you add to it, that's where the tax deduction comes from. And then money going out you can spread it out over many years to the charities at will, right? So it's the money going in that you get the tax deduction, but the money going out, you don't get any deduction because you already got it out on the front end. Very easy to set up, and it also streamlines the giving. So if you're giving it to multiple charities, it does help with the efficiency, in my experience. I just opened one up last year personally. It's great, really easy to manage. All right. All right, strategic tax loss harvesting, sell losing investments to realize a capital loss, offsetting capital gains and up to $3,000 of ordinary income. Okay, what does that mean? So when you have the opportunity to sell a position that's losing money, it's in your taxable account and you can offset other capital gains or up to $3,000 of ordinary income. And then you can also carry over what you don't use, the losses, that is. And when to do it? During the market downturns. We did a lot of this in 2022. And so when we were deploying capital, rebalancing some of the accounts, there might have been some losses. And then so we would sell one position, one security, and then buy a very similar security immediately. So it essentially stays invested. But we've realized losses, and those losses carried over for our clients for a few years to offset income and capital gains. And so by banking some of those losses, it's a strategy to also do some um, selling winners in the future because those gains are offset by losses you've banked. The thing to watch out for, it's called the wash sale rule. So you can't sell like Wells Fargo and then buy it immediately back the same day or the next day. There's a 30-day window. You have to wait to do that. So keep in mind, be aware of that. Um, I'm not going to get into the whole details of that, but I can off this call. But you want to make sure you don't do that. The other thing is can you talk, oh, I got a quick question. Can you talk about tax loss harvesting funds within the 401k itself? Yeah, it's a good question. So because it's a pre-tax account, things that if you were to buy and sell positions within the 401k, it's no taxable event because you're not going to pay taxes until you take dollars out of the 401k to like live on, for example. But when you make trades within the tax deferred account, or in this case, the 401k that David is asking, there's no tax benefit for you. So you're not harvesting a loss. Like the loss is in there as a loss, and it can't be used to offset. It can't be used in this strategy. Let's put it this way. Okay, so the last check mark here, RSRs, restricted stock rights or RSUs are taxed as ordinary income plan for vesting event. So yeah, it's just the IRS views it as when you get these shares and they vest, they view it up to that point, that level as income. Now at the vesting event, it's the strategy that I have with a lot of my clients is that you know, it's in their best interest to diversify because they've got a large quantity, large concentration. And if you sell a vest, that's essentially like your basis. And so if you time it right, you don't pay any capital gains. But it's again, everyone's situation is unique. But yeah, if you do get those restricted share rights over the years and you have some questions on that, I think it's really a good idea to speak with somebody one-on-one to make sure it's like what you're doing from a risk management piece and a tax management piece is working for you. Cool. All right, so let's kind of recap things. Annual checklist. So the core strategies, 401k choice, pre-tax versus Roth we talked about. You want to, make sure you've got a balanced approach there, but you essentially want to pay taxes when you're in the lower bracket. And we talked about the contribution limits, backdoor Roth IRA strategy, setting that up. Make sure be aware of that pro rata rule. Make sure you have a zero basis in the traditional IRA to maximize that strategy. Check withholding rates. We talked about that. and how that plays into this effective rate from your tax return. And I think on that note, the assumption when you adjust it, you're using historical data by looking at your tax returns. It's important to like forecast forward of what your expected income is going to be. And so what I do with clients when I help them with the check withholding rate is I'm actually doing a projection, taking that historical data and putting in what they expect to earn in that given year that we're looking at. Advanced is Roth conversions, the tax window. Again, that's usually in the future, but maybe some of you all are approaching that. Taxable account harvesting, just talked about that. Donor advised fund bunching, front loading your charitable contributions, and the IRMA review. Make sure you appeal it if it's in your best interest to save some money. So that's it, folks. I want to stop here for a question and answer session. I'm Britton Williams. Todd's put in our contact in the chat. He's also going to put in there the link to the retirement readiness quiz survey, and it's a really cool streamlined approach to identify some of the weaknesses in your financial makeup when it comes to retirement. And we're happy to talk with you to address any of those. But yeah, I'll stick around with any questions. Throw them in the chat, Q&A. Oh, you're welcome, David. Thanks for joining us. Very welcome.